The Reserve Bank doesn't sell houses, it doesn't build them either, but it decides how many people can afford one. Inflation, they say, is under control. The numbers tell a story of balance. But so did the Titanic's deck right before it tilted. The RBNZ is cornered. Cut too deep and we unleash a flood. Hold on too long and the engine stalls. Westpac's chief economist Kelly Eckhold is back. A man fluent in the language of markets, risk and restraint. Let's talk inflation, trade and the real cost of hesitation.
Financial freedom faster. Financial freedom faster.
If you like making money rather than watching everyone else do it, hit that subscribe button because the numbers don't lie. More investors are getting their New Zealand housing and real estate intel from this show than any other YouTube channel in 2025. Kelly, if inflation is forecast to fall below 2% by 2026, why isn't the RBNZ more confident in cutting faster?
One thing that's slowing them up is that before we get to next year, we've got to get through this year. And this year, we're basically looking at a rising headline inflation rate. Our forecast would suggest it'll get up to 2.7, 2.8%. Reserve Bank's not far behind that. And the reality is that we won't really quite know where that peaks until we get on to later in the year. So when the Reserve Bank looks at that and they look at some of the measures of inflation expectations coming from households and businesses, also suggests that people increasingly aware that inflation is going up as opposed to not going down, just makes them a bit leery about cutting rates further right now, because it might be the case that inflation isn't transitory. And in fact, perhaps we just might need to sit here for a while and make sure that inflation journey doesn't escape again like it did through 2021 and 2022.
So it's not the RBNZ protecting their reputation rather than Kiwis.
Well, I think the bankers, the MPC in particular, will be protecting their reputation in the sense that they have this mandate, which is about inflation control, and the government did change that mandate to more to squarely focus it on inflation control as well. So from their perspective, if the boss says that you just need to do that, then you can understand why they're focused on doing that.
So what happens if we bet on low inflation, but the global trade situation delivers the opposite?
So, yeah, I mean, the real challenge I think that countries have everywhere is the idea that instead of just inflation falling because global demand is weaker, that we get one of these stagflationary type environments where growth is actually weak, but inflation is not. And in economics terms, we call that a supply shock. It's a little bit similar to what we saw during the COVID period where supply chains got gummed up and it just suddenly became a lot more expensive to get stuff, to make stuff. It is a scenario that a lot of central banks are concerned about right now, and our own central bank, the Reserve Bank, did model a scenario where they said, well, if these tariffs basically force people to make stuff in different parts of the world, and in parts of the world where it's just going to be more expensive, well, then those costs are going to get passed through. And that might mean that we just end up with higher inflation, even though growth isn't that flash.
Yeah. And we're told that this is a data-driven cycle. What's the data set that breaks the cycle first? Where are you putting your attention?
I'm putting my attention quite carefully onto commodity prices because those are the really big supports of the economy right now. And that income is quite likely to flow through to the broader economy as we go through time. We've had some pretty good news this week. Well, yeah, we might have to do that, but again, my wife is just coming to the back.
Hello!
No, where was I? I was saying...
commodity prices.
I'm saying one of the big things that I'm focused on right now is what's going on with commodity prices, because those are the big support to the economy right now. And those are pretty significant income flows that if they continue for long enough, we will actually see that flow more broadly through the economy. Now, in terms of the increase in export values that we've seen in the last year or so, my colleagues have estimated that it could be adding about 5% of GDP on here. So that's actually pretty significant. And And, to the extent to which that was to be interrupted, I think that would really change the outlook quite a bit. So we need to watch that. And we also need to see sort of like how things like consumer spending increasingly respond to that, combined with this new government investor boost policy.
Just a reminder, your competition has already subscribed to the fastest growing property and investment channel in New Zealand. That means they're getting the insights first, making the moves first, and locking in profits while you're still debating whether to click a button. Be smart and subscribe. Trade protectionism seems to be what all countries are focusing on at the moment. How are we going to need to update our frameworks based on what's going on globally, especially between China and the US?
It really does emphasize the importance of diversification of trade flows, right? So if you're a country where you're heavily beholden to any individual country, that means that you're beholden to anything that changes the politics or the attitudes within that country. In our case, we actually have relatively undiversified destinations of trade. China is our biggest trading partner. The US is number 2 and Australia is number 3. There's quite important interrelationships between the three of them as well. So it means that we kind of have a common risk factor there. I think that emphasizes that as we go through the next 10 or 20 years, we need to kind of move to sell a bit of stuff to different places. That's where the opportunity is in Southeast Asia, in India, potentially with some of the new free trade deals that have been written up in the Middle East and in the UK, Europe as well. That's what we need to go for. So we don't have to worry if just some random negative event occurs in one country, that we've got other places to send our stuff to.
Well, there's one more cut projected, maybe 2 more cuts, depends on who you ask. Government's core spending is going to be going down based on what their budget says. How do these rate cuts support what the government's planning?
Well, one thing that lower interest rates helps the government is with respect to their financing costs. So that's actually quite an important benefit for the government if you think about those medium-term forecasts. I know the minister and the prime minister have both indicated the preference to see lower interest rates again as we go forward, because they see that as providing an extra impetus to the economy as we go through the next year or so. And, there is an election coming up next year, so you can understand why they would care about that. But I guess, from the market's perspective, from the Reserve Bank's perspective, they also care about the inflation as well. Because if you end up with higher inflation, you get higher interest rates anyway. And that really does mitigate against sort of debt sustainability, the ability to be able to get back to surplus.
Yeah. And GDP is crawling at the moment. It's relatively low. I've seen there has been some surprises, better than expected. How is what the government's spending money on, defense, education, health, how is that going to support a growing GDP? Why have they budgeted for such small growth when they're going to be spending more money?
They did that because the revenue outlook for the government for the next few years looks quite weak. And that's because partially they finalised their macroeconomic forecast underlying the budget right early on in April, when that Liberation Day tariff concern was right at its peak. Equity markets had plunged right about then. Things looked pretty dark. Now they don't look so dark because obviously some deals have been done, some pauses have been agreed. Equity markets are actually up for the year now. I think that if the Treasury redid their forecast again, they'd probably have a bit more revenue in the forecast, and that might allow for a bit more spending. Because as it was last in the budget, they basically had to cut back expected spending to make sure they still got back to surplus. And I think there could be some room for upside surprises there in the future.
Well, the New Zealand dollar is rising. Is it rising for the right reasons? Is it because of strength in agri and dairy and meat? Or is it just coming back to this weakness overseas?
The New Zealand dollar is actually still not especially strong. It's certainly tracked up against the US dollar in the last few weeks, and that's principally because the dollar's just gone down a bit. But at around 60 cents, that's a pretty good exchange rate to kind of like have when commodity prices are this high. I'd be a lot more concerned if we were kind of like up at 70 or 75 cents, because that would be taking away quite a lot of the benefits that we would otherwise be getting from the export industries. So I think that broadly the exchange rate is doing a good enough job. I think there are two-sided risks around it. Like if the economy can manage to recover quite well through this year, and if some of those kind of international trade concerns disappear, well, we could well track up, to be honest with you. But that would be a good thing, because that would be a signal that there was good news hitting the economy. And on the other side, the more darker side, well, if things go skew with, if the Chinese and the Americans can't deal, global growth really gets undermined because you end up with retaliation between countries on tariffs. Well, that's the sort of thing that I'd expect to see take the Kiwi lower. And unfortunately, that sort of scenario probably wouldn't play well for New Zealand either.
So in your view, the property market, residential property, still the backbone of Kiwi wealth, or is it still a risky situation for us?
You know, residential property is not as strong as it used to be, right? Like if you look at most metrics of the housing market, they're substantially weaker than they tended to be before the global financial crisis. Weaker credit growth, much less average house price growth. But I think there's still something there. Like one thing I noticed when I looked at the trends in credit to housing that's going on right now is that that's actually a relative bright spot in terms of driving an increase in credit across the whole economy right now. And within that housing segment, we actually see increasing credit to investors as well. It seems to be following the sort of path that we saw back in 2019 when interest rates were also being cut back then. And obviously they got cut quite significantly through the COVID period as well. What I suspect that means is that we're in a recovery period for investor housing. As a result, credit is gradually increasing. I don't think we're going to see a boom, because I don't think we'll see the sort of policies that we saw during COVID, which created some quite special conditions for the housing market back then. But I wouldn't at all be surprised to look back in, say, 6 or 9 months' time and see things, noticeably stronger.
Yeah, I was talking to a friend the other day. He said he sold his rental property for $1.3 million in 2021, and that property again is just resold for $1 million recently. So some people have lost out through this cycle, but you can also see the data from one of your reports is a lot of first home buyer activity in Wellington, where they've seen a huge drop in values from the peak. And now there's people taking advantage. And it was very interesting from your Cotality Westpac First Home Buyers report to see that the differences between their 1 year standard fixed rate, which was at 7.6% for 90% mortgages, versus the rate now. No, it's $1,000 a month cheaper for these first home buyers in Auckland. $870 cheaper for a month in Bay of Plenty. Like first home buyers are seeing a massive gain in reduced costs from the last couple of years. So it's good for some and not good for others.
Yeah, it's pretty significant, isn't it? Those are big numbers, right? They're much bigger than, say, tax cuts that got delivered last year. Across the economy, we estimate that the savings in terms of disposable incomes is kind of perhaps 5% of disposable income. So that's not to be sniffed at all. That's a lot more money in the pocket for everybody to be able to use, either to buy other things or for first home buyers to give them the opportunity to get in to the market.
Well, I appreciate your insights today, Kelly. And if you want to take advantage of that 3-year Westpac rate, you can talk to us and we'll help you lock it in. And look forward to talking to you again, Kelly.
Pleasure.
A final reminder, money moves fast and the investors making the most of it are here. This is the fastest growing property channel in New Zealand for a reason. If you don't subscribe now, just know that someone else is already using this knowledge to make their next deal while you hesitate.